Good morning, Mr. Joe. Thank you for having us here today as we present to you Leading the Evolution, our recommendation for mutual value creation in Singapore telecom. My name is Derek Rudiger, and today with me I have our team of Olivia Lee, Ronan Tall, and Christine Trandafalu. So we will bring you through the opportunity ahead of you, followed by our recommendation and some of the alternatives that we considered leading up to it. We will wrap up with the implementation and the financial impact that this strategy will have. Through Red Sea Investments' acquisition of Mobile One, a contractual alliance with Sadiqi Software House can create mutual value synergies, allowing Red Sea Investment to enjoy a 20 to 25% compounded annual growth rate on its investment. Furthermore, with the knowledge gained from a successful partnership, Red Sea and Sadiqi can build a model to further leverage their global telecom assets. From the information that you've provided to us, we've identified two main objectives for your firm. The first and most explicit is to maximize software house value, as this is an asset that has a strong potential to lead the 4G software evolution. Second, and more implicitly, we've identified the objective of strengthening your relationship with Red Sea Investment, because of course this is a firm that brings in more than 50% of your annual revenue. To achieve these objectives, everything will begin with Red Sea Investment's acquisition of Mobile One. At this point, we need to find a way to bridge the value creation gap in order to leverage potential synergies. And this will be done through a contractual alliance between the two firms. If we see value creation in red, value begins to rise up the chain, beginning with the Software House and Mobile One. By partnering with Mobile One, Software House now has a platform with which it can test and customize its 4G LTE software. While, by the end of the contract, Mobile One will have a fully operational set of software to use in its advanced consumer market, leading the race to 4G in Singapore. Finally, the value finishes upstream as it rises to Sadiqi Capital and Red Sea Investment, who now not only own these two extremely valuable assets, but have also built a model to leverage the remaining telecom assets globally.
Before arriving at this recommendation, we considered the alternatives available to Sadiqi Capital. We could sell the software as is and focus on new products, or test the software package in an already developed LTE network. However, both of these alternatives present us with extremely low returns on our already invested research and development, give us high costs and low flexibility. Therefore, we strongly urge the software house to partner with Mobile One. As Red Sea Investment acquires Mobile One, we feel the Singapore government will welcome the acquisition because we fall within all of the IDA regulations and contribute considerably to the IN 2015 goals. Red Sea Investments will be advised to purchase a majority equity share of Mobile One at a premium of between 20 and 30%, giving a purchase price per share of between 2.1 and 2.28 Singapore dollars. We arrived at the 20 to 30% premium by calculating the enterprise multiple for the three players in the industry. Arriving at an average of 1.17, we can see that Mobile One is undervalued by 25%. To keep our numbers conservative, we used a 30% premium, giving us a purchase stock price of at or below 2.28 Singapore dollars. In terms of the fee structure between Sadiqi Capital and Red Sea Investments, we did analyze using a carried interest approach. However, as Sadiqi has recently lost two of its analysts, we believe that it is best to continue with the traditional fee structure. Sadiqi should accept the normal consultation fee for its services, as well as take a minority equity stake in Mobile One to demonstrate your commitment to the company and your expectation of its high returns. To bridge the value creation gap, Software House and Mobile One will form a contractual alliance in which Mobile One will contribute all of the infrastructure and hardware and bear its respective costs. The Software House will be responsible for the software suite and all developmental costs. Mobile One will also have the option of serving as a pilot program for future packages developed by the Software House and gain the right of first refusal in the Singapore market. In order to satisfy the goals of both parties, we will focus on the development of software for launching the global market, as well as tailoring the software package to the unique needs of Mobile One in the Singapore market. We expect the contract to conclude between 6 and 12 months after its formation.
With regards to management of Mobile One after the acquisition, we investigated the possibility of hiring a brand new team of senior managers in order to ensure the new vision. However, we believe that retaining the existing team of managers is in the best interest of the company and of Red Sea Investment, as the managers have a history of innovation, having led Singapore to the current 3G network, have the support of all employees, and have maintained stable operations for the past several years. Instead, we will ensure this brand new vision via the new Contractual Alliance Committee. This committee, which will run between 900,000 and 1.35 million Singapore dollars, will comprise 5 individuals: the head engineer from Software House as its representative, Lena Lee from Mobile One as its representative, and 3 new people to sit on the committee, including the project director. What kind of individuals are we looking for? We're looking for individuals who have experience in the telecom industry, have a global vision, and are customer-driven to ensure the best quality possible. In addition, we believe that our project director should have a background in engineering. One ideal candidate that we have found is Mr. Jeong Kim, current VP of Alcatel-Lucent. How are we going to bring these 2 companies together? We have developed an event called Friday at the Fringe to be held this year at Singapore's Fringe Festival, an event well known for its creativity, innovation, and forward thinking. And with Mobile One already set as its title sponsor, it is the perfect forum for these 2 companies to meet. We will begin the acquisition of Mobile One very shortly in September 2009, and at the same time begin to form the Contractual Alliance, which should be ready by March 2010. At the same time, we will begin testing the new software and develop the infrastructure necessary for Singapore's 4G LTE network, which should be ready to roll out at the earliest by September 2010 and no later than September 2011. It is important to remember that although the companies each have 2 very individual goals here, they both lead to the same common objective: Singapore's first 4G LTE network. For Mobile One, this is a positioning alliance, as they will hope to develop the dominant standard in the Singapore market by establishing the first 4G LTE network. Software House, on the other hand, is engaging in a learning alliance, hoping to develop new capabilities via tech transfer with Mobile One. In turn, they will fine-tune their software and be able to license it globally for even greater profits. For Sadiqi Capital and Red Sea Investment, the value that created expands across the globe. Not only will Software House be able to license its new software across various markets, but Sadiqi Capital and Red Sea can also replicate this business model across their other global investments, yielding even greater revenues.
In terms of developing the 4G network, we are looking at a total investment of 400 to 550 million Singapore dollars, which was benchmarked against a similar project that Verizon Wireless undertook in the United States. M1 has already invested a total of 225 million since 2007, and we are expecting Red Sea investment to inject an additional 100 million, either through convertible bonds, debt, or equity. The balance of $75 to $225 million can be easily covered by M1's operating cash flow, which in 2008 was standing at 255 million Singapore dollars, and as well by their long-term debt, which is expected to expire by 2010. For our financials, we assume the following: an increase in users, by which 2020 we'd reach over 2 million users, an increase in post-paid annual revenue per user, at which right now we are standing at $618, and it would optimistically increase to $693. And lastly, a decrease in cost of sales thanks to a more efficient network. As you can see, we are expecting to break even within the first year optimistically and pessimistically by 2014. And both scenarios take into consideration the payout ratio of 80% that Mobile One has undertaken for the last few years. In terms of return to RSI, we benchmark it against a similar project that M1 undertook, the 3G launch back in 2003. Within the first 2 years, the stock price had a compounded annual growth rate of 34%. In addition to this, M1 had continuously paid dividends of approximately 11 cents per stock annually. Adding these 2 factors together, we get a compounded annual growth rate of 20 to 25%. In other words, after the first year, the exit strategy for RSI can be initiated as they will have already realized profits on their investment. RSI will have the option to either hold their stocks or sell it at a profit. In conclusion, we strongly urge you to undertake the business model proposed, to leverage the knowledge at the parent company level, so that you can maximize the value of your software house, strengthen your relationship with Red Sea Investment, and finally, leverage your knowledge with all your global assets.
Thank you very much, and we hope to see you soon.